Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive.
Great to be back.
Today, we're breaking down a titan of industry, a name many recognize, but maybe don't fully grasp in its current form. GE Aerospace.
Right. Post-spinoff, it's a very different beast, a focused powerhouse.
Exactly. On the surface, it looks like a dominant, essential business. But the real question for us as long-term investors is this. Is the market already pricing in perfection, or are there nuances and risks being overlooked? That's what we're here to find out.
That's a massive question. And before we get into the details, just a quick note for everyone watching.
For those who want to act on these investing ideas, having a professional-grade platform is key. We use Interactive Brokers, and we've partnered with them to get our viewers a stock bonus when they sign up.
So they get a bonus and support the channel at the same time. That link is in the description, right?
That's right. And of course, if you find value in this kind of in-depth discussion, the best way to let us know and to get the next one is to subscribe and like the video. It truly helps the channel.
Absolutely.
And if you have any questions regarding the company, please manifest yourself in the comment section.
Perfect. Now let's get into it. Pillar number 1, the business model.
Okay, let's unpack this GE Aerospace story. Forget the old GE conglomerate for a moment.
Yeah, this is purely aerospace now, a focused play.
Our mission today, for you listening, is really to get under the hood. Not just what GE Aerospace does, but how it does it. What makes it tick.
What's its edge? And critically, what factors really matter for its long-term success?
Exactly. We've gone through a pretty deep analysis framework, the kind top analysts use, and we're going to distill that down for you.
And what stands out right away, I think, is just the sheer scale and how indispensable this company is to the global economy.
Indispensable is a strong word, but maybe accurate?
I think so. I mean, it's not just another industrial firm. It's really fundamental to modern air travel, to global logistics.
Think about all the flights happening right now.
Exactly. Millions of people flying daily. And GE Tech is powering a huge chunk of those planes. Moving goods, moving people, it relies on what these guys make and service.
That level of integration, being so deep inside essential global infrastructure, just makes it a fascinating company to dig into. It suggests a kind of robustness you don't see everywhere.
Definitely. A real bedrock kind of business in some ways.
So let's peel back that first layer. How does this business actually make money? What's the core engine here?
It's a classic model, really, executed on an unbelievable scale. You could call it the razor and billion-hour bleeds model.
Okay, explain that. The razor is?
The razor is the initial sale of the jet engine itself, or the propulsion system, these incredibly complex machines.
Which they design, build, sell,
Okay.
both under the GE brand and through that big joint venture, right? CFM International.
Exactly. That 50-50 JV with Safran Aircraft Engines, CFM, is absolutely central, especially for their commercial success, the narrow-body stuff we'll get into.
Okay, so they sell the engine, the razor,
Yeah.
but here's the twist, right? These initial sales, they aren't the main profit source.
Not at all. That part, the engine sale, it's maybe only 30% of their total revenue, and often the margins are really low, sometimes even negative.
Selling at a loss. Why do that?
It sounds counterintuitive, but it's strategic brilliance. The goal isn't profit on day one. It's about getting that engine onto the plane, securing placement.
Locking it in on new aircraft platforms.
Precisely. Every engine they sell adds to what they call their installed base. That's just the total number of GE or CFM engines flying out there.
And the bigger that base.
The more opportunities you have for the real moneymaker, the blades.
Okay, so the blades are?
That's the aftermarket services. This is where the economic engine truly hums. It's recurring, it's high margin, hugely high margin, actually.
And it's the bulk of the revenue.
Yeah, around 70% of total revenue comes from services. But it contributes an even bigger slice of the actual profit, disproportionately large.
What kinds of services are we talking about? Oil changes and tune-ups?
A bit more complex than that. It's a whole spectrum. Scheduled maintenance, yeah, but also intricate component repairs, full engine overhauls.
MRO, right? Maintenance, repair, overhaul.
Exactly, MRO. And crucially, selling their proprietary spare parts. You need a specific GE part, you generally have to go to GE.
Okay, so give us a sense of the scale here. How big is this installed base we're talking about?
It's staggering. GE and its partners, mainly CFM, have over 70,000 engines in service globally.
70,000.
70,000. Break that down. It's about 44,000 commercial engines and maybe 26,000 for defense applications.
Wow. What does that mean in terms of flights?
It means their tech powers, quite literally, something like 3 out of every 4 commercial flights around the world.
3 out of 4.
Think about it. Right now, as we speak, there are probably close to 1 million people up in the sky relying on GE propulsion technology, directly or indirectly.
That's not just market share. That's, like you said, almost indispensable. Market omnipresence.
It really is.
So what makes this razor and blades model so durable? Why does it work so well here?
Well, the core logic is powerful. You're selling this incredibly complex, safety-critical piece of equipment, the engine.
Can't compromise on safety there.
Absolutely not. And once an airline commits to your engine for a specific plane type, they're essentially locked in, contractually, practically, for decades.
Decades.
Yeah, locked into buying those essential high-margin services for the entire life of that airframe, which can be 20, 30 years or more.
So it's not like switching your brand of smartphone.
Not even close. This business isn't driven by fleeting trends or rapid tech changes like consumer electronics. It's tied to something much more fundamental.
Yeah.
The basic human desire and economic need for travel, for commerce, for moving things around the globe efficiently. That gives it this incredible endurance.
And looking ahead, those fundamental needs aren't going away.
Quite the opposite. If you connect this to the bigger picture, the secular tailwinds are huge. Global passenger traffic.
It's projected to double over the next 2 decades.
Double, despite climate concerns and everything.
That's the projection, yeah. Driven by the growing global middle class, increasing connectivity, it's a deeply embedded trend. That provides a structural demand lift for the whole industry.
And especially for GE's engines and, more importantly, those services.
Exactly. And the core know-how here is sticky. The actual physics of flight, the material science needed for turbines, these aren't things that get disrupted overnight like software.
Aircraft life cycles are incredibly long, too.
Right, 20, 30, sometimes more years. That built-in longevity gives you amazing long-term visibility on that crucial services revenue.
What about new technologies? Sustainable fuels, hydrogen. Does that threaten the model? It's evolving, for sure. But even with sustainable aviation fuels, SAF, or potentially hydrogen down the line, you'll likely still need sophisticated thermal engines, at least for the foreseeable future.
The core turbine technology remains relevant.
Very relevant. And GE isn't just sitting back. They're a leader in this space, investing heavily to stay ahead, ensuring they're relevant for decades, whatever the fuel source looks like.
Okay, so this leads to something you mentioned, a flywheel. How does that work?
Right, it's this powerful self-reinforcing cycle. Think about all those older, reliable engines already flying, like the CFM56, a real workhorse.
The engine on tons of older 737s and A320s.
Exactly. That massive installed base generates huge, predictable cash flow from services. Very profitable cash flow.
Okay, cash comes in from the old engines.
And that cash isn't just sitting there. It gets plowed right back into a massive R&D budget. We're talking something like $2.7 billion a year, including partner and customer funding.
So the legacy profits fund the future.
Precisely. That huge R&D spend fuels the development of the next generation engines. Things like the LEAP, the GeneX, and looking further out, the CFM RISE program.
Which gives them a technological edge to win new plane deals.
Bingo! That sustained tech leadership lets them win exclusive spots, or at least dominant share, on the newest, highest volume aircraft platforms.
Like the LEAP engine being the only choice for the Boeing 737 MAX.
Perfect example. That decision alone locks in revenue for decades. And every single one of those new LEAP engines sold
Becomes a new razor, setting up 20, 30 years of high-margin blade revenue.
You got it. It grows the future installed base and expands the future profit pool. It's like a capital compounding machine that just finances its own dominance. Makes it incredibly hard for anyone else to break in.
This sounds like a classic economic moat.
Absolutely. And that's exactly how firms like Morningstar rate in a wide economic moat. Their highest rating.
Meaning, they think GE Aerospace can earn high returns on capital for a long, long time.
At least the next 2 decades is their definition. And this fortress, as you called it, it really rests on 2 main pillars: intangible assets and high switching costs.
Okay, break down intangible assets in this context.
Well, first, it's decades of proprietary technical know-how, just accumulated expertise in designing, building, servicing these incredibly complex machines.
Stuff you can't just learn from a textbook.
Exactly. Hard-won knowledge protected by a massive patent portfolio. Then there's the GE brand itself. In aviation, that name means safety, reliability, paramount virtues.
Trust is huge in this industry.
Non-negotiable. And you can't forget the regulatory hurdles. Getting a new engine certified by the FAA in the US, EASA in Europe, it takes years, sometimes a decade, and incredible investment.
So it's really hard for a new player to even get started.
Astronomically hard. The cost and time involved create this massive structural barrier protecting the incumbents.
Okay, so that's intangibles. What about the second pillar, high switching costs?
This layers right on top. Once an airline picks an engine for a fleet, say, LEAT engines for all their new 737 MAXs, they're basically stuck with it for the life of those planes.
Why stuck? Can't they just swap engines later?
Oh, technically possible maybe, but practically a nightmare. Think about it. You'd need hugely expensive engineering changes to the plane itself.
Different mounting points, systems?
Right. Plus, a whole new set of maintenance tools, a completely separate spare parts inventory, retraining all your pilots, mechanics, ground crew. The cost and complexity are just prohibitive.
So it locks them into GE's service network for decades.
Exactly. It creates this deeply captive customer base for the high-margin aftermarket services, giving GE significant pricing power over a very long time horizon.
Has there been a real-world example of this playing out recently?
Absolutely, a very clear one. Look at the Airbus A320neo family. That's one of the few big platforms where airlines actually have an engine choice.
GE CFM's LEAP versus Pratt & Whitney's GTF engine.
Right. Pratt & Whitney, part of RTX, came out with their new geared turbofan, the GTF. Innovative tech, but it ran into serious, highly public reliability and durability problems.
I remember hearing about that. Grounded planes, big financial hits for Pratt & Whitney.
Billions in charges, yes. And what happened? Airlines, understandably wanting reliability, started switching their A320neo orders in droves over to the CFM LAP engine.
So GE benefited directly from the competitors' problems.
Massively. As of now, LAP is the engine of choice for over 100 customers on more than 2,000 of those Airbus single-aisle jets. It's a perfect illustration.
GE's reputation for reliability and intangible asset allowed them to capitalize.
And then the high switching costs lock in those gains for decades. Securing that future high-margin service revenue stream, that's the moat in action.
So it's not just a static moat. It seems like it's actually getting wider.
I think there's strong evidence for that. First, just the huge adoption of the LAP engine itself is expanding that future installed base, which feeds the service business.
More razors mean more future blade sales.
Exactly. Second, those P&W GTF issues, frankly, damage their reputation. It makes risk-averse airlines even more likely to stick with the proven incumbent, GE-CFM, for future orders.
Reinforces GE's brand strength.
Third, GE keeps investing heavily in the next generation, like the CFM Rise program aiming for a 20% plus better fuel efficiency. That extends their tech lead, making it harder for anyone to catch up.
And you mentioned a digital layer.
Right. They're using AI, data analytics to optimize maintenance, predict problems, manage the supply chain better. As their scale grows, their data advantage gets stronger, creating another layer of insulation that's hard to replicate.
This sounds like that idea from Charlie Munger.
Yeah.
The Lollapalooza effect.
Precisely. It's when you have several powerful forces all pointing the same way. The result isn't just additive, it's multiplicative. It creates this overwhelming outcome.
So it's not just one thing for GE Aerospace.
No, it's the interplay. The intangible assets, the know-how, the brand enable scale economies. Their huge size gives them cost advantages in manufacturing, sourcing, service delivery.
Scale that smaller players can't match.
Right. That scale then helps create the high switching costs, locking customers in. And the whole thing is protected by those massive regulatory barriers.
They all reinforce each other.
Profoundly intertwined, constantly amplifying each other. The trusted brand wins deals, grows the base, generates cash for R&D, strengthens the brand further, all while switching costs keep customers captive.
It's a really elegant and honestly viciously effective cycle.
It really is. The Lollapalooza result is this almost impenetrable competitive fortress in what's essentially a duopoly, maybe an oligopoly.
Systematically financing its own dominance. Hard to compete with that.
Very hard.
Okay, beyond the structure, what about the softer stuff? Customer sentiment, employee morale.
Yeah.
That's scuttlebutt insight.
Right. You can't exactly read Amazon reviews for jet engines, but you infer customer sentiment from behavior.
And the behavior seems positive.
Overwhelmingly. Look at their order backlog, over $170 billion. That's enormous.
Just numbers, or are there specific big deals?
Oh, yeah. Huge recent deals. Qatar Airways ordered over 400 wide-body engines, GE's biggest deal ever. IAG for British Airways placed a major order too.
These aren't small airlines. These are sophisticated buyers making huge long-term bets.
Exactly. It's a massive vote of confidence from the most demanding customers, signaling deep trust in the product and the support.
What else signals that trust?
Well, their whole operational mantra, SQDC, safety, quality, delivery, cost, always in that order. That resonates deeply with airlines where safety is number one.
It's not just a slogan, it's how they operate.
And they partner actively, too. Developing tools like Flight Pulse gives pilots real-time data to save fuel, improve safety. It makes GE more than just a supplier. They're a critical partner.
Okay, shifting gears to the employees. What's the vibe inside the company? Glassdoor reviews, that sort of thing.
You see a pretty clear picture. People talk about the work being highly technical, challenging, but also really meaningful. Building safety-critical machines.
Sense of purpose.
Definitely. And stability.
Yeah.
Lots of long-tenured employees, which suggests they retain that deep institutional knowledge.
Any recurring complaints? Nowhere's perfect.
Sure. You see mentions of compensation sometimes, annual raises, maybe not keeping up with inflation, and the hiring process can sometimes be seen as slow or bureaucratic. Typical big company stuff, maybe.
But nothing suggesting a fundamental problem with quality or safety culture.
No, not systemically. The engineering culture seems incredibly robust, and CEO Larry Culp's big push on lean principles, that flight deck system.
Based on his Danaher playbook, right? Kaizen, continuous improvement.
Exactly. It empowers people on the shop floor, fosters ownership, plus they gave every employee equity when they launched as a standalone company. That builds alignment.
Shared purpose.
Right. So while you always need to watch compensation to keep talent, the core culture seems strong, focused on the right things. No signs of rot that would threaten the business long term.
Okay, let's look outwards again. The competition. You said oligopoly.
Yeah, it's a classic functional oligopoly, really only 3 main players globally at this scale.
Why so few?
It's just the sheer capital needed, the decades it takes to build the tech expertise, and those regulatory hurdles we talked about. The barriers to entry are immense.
So here are the big 3.
You've got GE Aerospace, including CFM, dominant in narrow bodies, strong in wide bodies too. Their game is scale, reliability, that global service network.
Okay, number 2.
Pratt and Whitney, part of RTX. They compete directly in narrow bodies with that GTF engine, the one with the issues. They're also strong in defense and regional jets.
And the 3rd?
Rolls-Royce. They're different, almost exclusively focused on engines for wide-body aircraft. No real presence in the narrow-body fight. They're doing their own turnaround effort now too.
So GE, Pratt and Whitney, Rolls-Royce. What does this structure mean for GE's position, especially with CFM?
Okay, here's the crucial part. The narrow-body market, think Boeing 737s, Airbus A320s, that is by far the biggest and fastest-growing slice of commercial aviation.
The workhorses for most airlines.
Absolutely. They're the backbone. Dominating that segment gives you an incredibly powerful base for growth and profit, much more so than just wide bodies.
And GE CFM's position there is?
Near unassailable. Seriously dominant.
How so?
Consider this. CFM is the only engine supplier for the entire Boeing 737 MAX family.
Exclusive.
Exclusive. On the best-selling commercial jet platform in history, that's a locked-in, multi-decade stream of future service revenue right there.
Wow. And on the Airbus side, the A320neo.
They've captured the commanding majority share with the LEP engine, largely because of the competitor P&W's GTF problems. Rolls-Royce isn't even in this market.
So in the biggest, most important segment,
GE CFM reigns supreme. It's not just an advantage, it's structural dominance. This narrow-body kingdom is the bedrock of the whole GE Aerospace enterprise for decades to come.
Okay, let's talk leadership and financials. A great business can stumble with bad management, right?
Absolutely critical, but that doesn't seem to be the case here. Larry Culp is chairman and CEO.
The guy who came in to turn around the old GE.
That's him. Took over GE in 2018. His whole philosophy comes from his time running Danaher, famous for its lean manufacturing operational excellence, the Danaher business system.
And he brought that mindset to GE Aerospace.
Totally. You see it in his focus, his language. He talks like a long-term owner, prioritizes deep operational excellence, not just financial tricks.
What's this flight deck thing?
That's their version of the lean operating model. It's not just a poster on the wall. It's a systematic, hands-on approach. Continuous improvement, Kaizen, eliminating waste.
Focused on?
Delivering customer value by improving SQDC safety, quality, delivery, cost. And he stresses always in that order.
The safety first.
Always. It shows a real focus on building the business from the ground up, focusing on the shop floor, the details that actually drive results.
Right.
He acts like an operator, not just a distant exec.
And how is management incentivized? Are their interests aligned with shareholders?
Very tightly, it seems. A big chunk of executive pay, especially Culp's, is at risk, tied directly to hitting tough performance goals.
Like what?
Well, when they launched as a standalone, the board locked Culp in through 2027 with a new contract. Key part was a big grant of performance stock units, PSUs.
Performance-based.
Exactly. They only vest, become real shares, if the company hits its ambitious 2028 operating profit target around $10 billion.
So his big payday depends entirely on hitting the company's long-term goals.
Precisely. That's serious skin in the game. A very clear alignment. Shows the board's confidence he's the right guy to deliver.
Okay, what about how they use the cash the business generates? Capital allocation.
They've laid out a very clear, disciplined framework since going independent. Seems very rational.
What are the priorities?
Simple. First, reinvest aggressively back into the core business. Strengthen the moat, keep the tech lead, fund growth.
Makes sense. Build a machine first.
Right. Only after those internal needs are met do they focus on returning cash to shareholders. The target is to return about 70–75% of available funds.
Oh, dividends, buybacks.
Both. They quickly set up a sustainable dividend, about 30% of net income. And significantly, they authorized a huge $15 billion share buyback program over 3 years.
$15 billion, that's substantial.
Very. And they've been acting on it fast, already returned over $6 billion in the first year as a standalone. Shows they're serious about the framework.
So reinvest first, then return the majority of the rest. Sounds sensible.
It passes the rationality test.
Yeah.
Prioritizes strengthening the core high-return business and that big buyback. It's also a signal, isn't it?
How so?
Management is essentially saying they think their own stock is attractively priced, undervalued even, and they're putting serious money behind that belief by reducing the share count. It's a strong vote of confidence in their own future prospects.
Okay, qualitatively, the financial picture sounds strong. The crown jewel after the spin-offs.
Absolutely. It's now a focused financial profile. High profitability, strong cash generation, without the drag from the old conglomerate structure.
And the performance numbers back that up.
Definitely accelerating. Aerospace profit grew 28% in 2023 to $6.1 billion. And for 2024, the first full standalone year, they're projecting around 30% growth in operating profit.
Driven by that services business.
Yeah, that high-margin services component provides this incredibly consistent, resilient stream of earnings and, crucially, free cash flow.
Yeah.
It buffers them against wider economic swings.
Let's get into some key ratios. You mentioned ROIC, return on invested capital.
Right. Their ROIC is consistently in the 15–20% range. That's really impressive.
Why is that significant?
Think of ROIC as measuring how well they turn invested capital into profits. A sustained rate like that, well above their cost of capital, is a classic sign of a wide moat business. It means they're creating real economic value, not just growing for growth's sake.
Okay, what else? Free cash flow conversion.
They target over 100%, which is excellent. Free cash flow is the actual cash left after running the business and reinvesting.
So 100% means the profits are real cash.
Exactly. High earnings quality. The profits aren't just accounting numbers. They're backed by cash in the bank. Very important.
And debt levels.
Pretty conservative. Net debt to EBITDA is under 2.0x. That's a strong balance sheet compared to many peers.
Meaning they have flexibility?
Lots of flexibility. They can handle downturns better or jump on strategic opportunities if they arise. It's a financially robust position.
Okay, so great business, strong financials, good management. But the elephant in the room, valuation.
Always. The classic investing dilemma. Even the best company can be a bad investment if you overpay.
And GE Aerospace. It's not exactly cheap, is it?
No, definitely not. As this premier global aerospace franchise, it commands a premium valuation. The market sees the quality, the durable services, the moat, the management. It's recognized.
So the price reflects that optimism.
Fully. You look at the multiples forward PE around 38x, EBITDA over 30x. These are numbers that bake in high expectations for future growth and execution.
So finding a traditional margin of safety, buying it statistically cheap, is unlikely.
Very unlikely for a company like this. It comes back to that Buffett idea. Better to buy a wonderful company at a fair price than a fair company at a wonderful price.
The challenge is figuring out what's fair for this kind of quality.
Exactly.
So when might a fair price, an adequate margin of safety actually appear for a business like this?
Realistically, probably one of two scenarios. First, some kind of market-wide panic, a big crash, a deep recession, something that causes indiscriminate selling.
Throwing the baby out with the bathwater.
Right. In that chaos, even great companies get dragged down, and a long-term investor with cash could potentially step in at a much more reasonable valuation, maybe even a discount.
Okay, scenario 1, market meltdown. What's scenario 2?
A company-specific setback, but one that's temporary. Something that spooks the market short-term, but doesn't fundamentally break the long-term story.
Like what?
Could be a serious supply chain snag hitting deliveries for a quarter or two. Or maybe an engine issue that requires a costly recall, but isn't a fundamental design flaw, you know?
Yep.
Something manageable. Or just a cyclical dip in air travel.
Yeah, temporary slowdown, reducing flight hours. Things like that, while painful near term, could knock the stock down, creating an entry point for someone focused on the next 10, 20 years of that installed base.
So the quality isn't a secret? The price reflects that.
Fully reflects it, which means the price you pay today is absolutely critical for your future returns. It's the final hurdle.
Looking at future growth, what's the absolute key driver?
It really boils down to one thing: the continued build-out and then the long-term servicing of that CFM LEPP engine installed base.
The engine on the 737 MAX and A320neo.
Right. Thousands more of those planes are entering service over the next decade.
Yeah.
Each one sees this massive, multi-decade waves of high-margin aftermarket revenue.
So the LEP service profits are expected to be huge.
Expected to eventually dwarf the already massive profits from the older CFM56 fleet. That's the engine driving significant sustainable earnings and cash flow growth for years, even decades to come. The growth curve is kind of locked in already. Okay, but no business is risk-free. What are the real long-term dangers here? Things that could permanently damage the business.
Right, beyond just normal cycles. The biggest one, the existential risk, is a catastrophic design or manufacturing flaw.
Something fundamentally wrong with a major engine like LA or GX?
Exactly. If something systemic emerged, leading to a major safety incident, a fleet grounding, the financial cost would be immense, but the damage to the GE brand's safety reputation could be irreparable.
Losing that trust.
Would be devastating, could lead to permanent market share loss. You just have to look at the damage Pratt and Whitney suffered with the GTF, even on a smaller scale, to see the danger.
Okay, what else? Technological disruption.
Less immediate, maybe, but still a risk. Some radical breakthrough by a competitor that makes GE's thermal engine expertise obsolete.
Like large-scale electric or hydrogen propulsion that works differently.
Right. Now, GE is investing heavily in things like the RISE program to lead that transition themselves. But the risk of being leapfrogged by someone else, however small, exists. That would be fundamental impairment.
And the third big one.
A permanent shock to travel itself. A really severe, long-lasting global conflict, maybe climate disasters, or another pandemic that structurally reduces the world's willingness or ability to fly long-term.
If global flight hours permanently decline.
That hits the core growth driver new engines, and especially those high-margin services. That's the lifeblood.
Okay, besides that core growth from the LEAP services, are there shorter-term catalysts that could boost value, say, next few years?
Definitely. One obvious one is that big share repurchase program.
A $15 billion one.
Right. As they actively deploy that cash to buy back stock, it provides steady demand for the shares and directly increases earnings per share because the pie is split fewer ways.
And if they buy back opportunistically when the stock dips?
It becomes even more accretive, adding more value per share for the remaining owners, potentially enhancing long-term returns significantly.
What else?
Progress on that CFM RISE program. That's the next-gen tech, the open fan architecture.
Aiming for big fuel savings.
Huge savings. As that program hits key development milestones, passes tough tests, moves toward certification, the market will gain confidence that GE can define the next era of flight, too.
De-risking the long-term roadmap.
Exactly. Positive news there could lead to the stock re-rating higher as the market starts pricing in another generation of dominance and those multi-decade revenue streams.
Okay, let's try some second-level thinking here. What's the market consensus on GE Aerospace?
Overwhelmingly positive. You look at analyst ratings, mostly strong buys or moderate buys. Price targets are optimistic.
The market clearly gets the quality story.
Absolutely. The razor blades model, the Moat, Culp's leadership, that's all well understood and reflected in that premium valuation we talked about.
So where's the second-level insight if our analysis basically agrees on the quality?
Well, this is fascinating. The contrarian angle isn't disagreeing that it's a wonderful company. It is. The contrarian thought lies in the implication of that high valuation. Meaning, the market seems to be pricing in near-perfect execution, smooth sailing ahead. It might be underappreciating the potential for near-term bumps.
Like those supply chain issues, geopolitical risks, a possible cyclical slowdown.
Exactly. Things that probably won't break the company long-term, but could definitely cause short-term pain and maybe create that margin of safety opportunity that the current consensus view isn't really considering.
So the edge isn't knowing it's a great business.
The market knows that. The edge is having the patience and discipline to wait for a fair price, which might only appear when the market gets distracted by temporary noise.
Okay, let's synthesize. The bull case for GE Aerospace. What are the core pillars?
All right. 1. Dominant market position in a rational oligopoly. Huge barriers to entry, especially that commanding lead in the critical narrowbody segment.
Sure.
That powerful flywheel business model. Massive installed base, locked-in customers, generating decades of predictable high-margin recurring service revenue that funds future dominance. Exceptional management under Culp. Proven operator, lean culture, rational capital allocation focused on reinvestment and shareholder returns.
And 4.
Those durable secular tailwinds, directly benefiting from the long-term structural growth in global air travel.
Okay, sounds compelling. Now, play devil's advocate. The bear case.
All right, counter thesis. 1. Valuation, it's demanding. Price for perfection, leaving little room for error or setbacks.
2.
Execution risk. Ramping up production to meet that huge backlog while navigating fragile supply chains is a massive operational challenge. Failure to deliver or manage costs could hurt.
3.
That single point of failure risk. Heavy concentration in commercial aviation makes them vulnerable to a truly catastrophic engine flaw or a structural shock that permanently cripples air travel demand.
And you mentioned a red team challenge, more subtle bear argument.
Yeah, this one is maybe the most interesting long-term risk related to the valuation. The bull case assumes the service profitability on the new LEAP engines will be as good as or even better than the old CFM56.
Is that guaranteed?
Not necessarily. The LEAP is a much more complex engine. Advanced materials like CMCs, additive manufacturing. What if that complexity leads to higher long-term maintenance costs than expected?
Or maybe unforeseen durability issues pop up years down the road.
Exactly.
Yeah.
If those projected high service margins don't fully materialize over the AAP's 30-year life.
Then the growth baked into today's price might not happen.
Precisely. GE Aerospace would still be a very good, wide moat business generating lots of cash, but it might fail to be the exceptional compounder the current valuation implies.
So buying a great company, but maybe at a price only justified by exceptional, not just great, future results, leading to disappointing returns.
That's the core of that specific valuation-based bear argument.
So wrapping this all up after this incredibly detailed deep dive, what's the key takeaway for you, our listener?
I think it underscores that fundamental investing truth. Understanding the business deeply, the moat, the management, the finances, like we've tried to unpack, it's absolutely vital.
It's not enough on its own.
Right. Because ultimately, the price you pay, even for the most wonderful company, is what dictates your future return. Overpay, even for the best, and your results might just be mediocre.
Which leads to that final provocative thought.
Yeah, a question for you to constantly ask yourself. How do you spot true long-term value? And maybe more importantly, how do you cultivate the patience needed in a market that often prices in perfection?
Where are the opportunities?
What temporary setbacks, what moments of market fear or focus on short-term noise could create your chance to buy into these truly great businesses, like GE Aerospace potentially is, at a price the short-sighted market might be temporarily overlooking?
Finding that disconnect between temporary perception and long-term reality.
That's often where the real advantage lies.